Hello, everyone. Thank you for taking your time to attend today's webinar. My name is Yinka Ayeni, your ACCA online chapter head. I'm the moderator for today's webinar. I am a senior accountant with the Colorado Department of Revenue in Denver, Colorado. I also worked as an accountant with Manitoba Liquor and Lotteries in Winnipeg, Canada, where I obtained my Chartered Professional Accountant and my ACCA membership. I have a bachelor's degree in accounting from Bowen University in Nigeria and master's degree in management from University of Lease, United Kingdom. Today's webinar will focus on the new IFRS updates as well as President McEnery journey towards ACCA qualification. Our presenter today is Mr. Brian McEnery. Brian is a partner in BDO Corporate Finance and Recovery Department, having joined the firm in April 2012. He is one of the country leading insolvency practitioners with over 15 years specialized experience and has been involved with numerous high-profile cases and clients. A very quick look at his successful career includes Brian was appointed as non-executive director of National Asset Management Agency by the Minister of Finance in December 2009 for a 4-year term. Brian is a director of the Lamcry Chapters of Commerce and a member of the foundation body of Lambrick Institute of Technology. Being the 2009 and 10 president of ACCA Highland and is a member of ACCA Global Governing Council, a group of 36 elected members, all ACCA qualified, who collectively form the governing body that is responsible for ACCA strategy and on-timely accountability to members. He is also related to serve a 3-year term in May 2009. Brian was elected in 2016 as the ACCA Global President. Before we start, I would like to remind you of a few housekeeping rules. Which include, please can you keep yourself on mute if I have not put it on mute. This will help to eliminate any background noise during the presentation. We are also recording the presentation for future viewing. There will be a 3 short poll question during the presentation and a short evaluation after the presentation. We will appreciate if you can participate. And if you are looking to get a CPA certificate, you have to complete the 3 polling questions in order to be able to get certificates. The CPA certificate will be emailed within 3 business days. Let me launch the first poll question we have today, which should just take us like 10 seconds before I pass it to Brian. Okay, I'm closing the poll now. Sorry, I'm just waiting for Brian to come online, then we can start. Okay, we have Brian on the line now. Hello, Brian. Hello? Hello, Brian.
Unmute it now.
Yes.
Can you
Hello.
hear me now?
Can you hear me?
Yes, I can hear you.
Wonderful. Well, hello everyone and welcome to today's webinar. My name is Brian McEnery and I am the president of ACCA. And I'd like to start by thanking Yinka and Sumaya, both our online chapter head and our deputy online chapter head, for facilitating this session today. So I will be speaking to you about some of the latest developments in IFRS standards. But let me first introduce myself, including my work outside of ACCA, and briefly contextualize ACCA's work on IFRS. I'm a long-standing ACCA member, qualifying straight out of school, and currently balance 4 roles. The first is the day job, and that is as a partner in BDO, specializing in business rescue and healthcare consulting. In my native Ireland, I'm a director of the National Asset Management Agency, NAMA, which is a bad bank or a non-performing loan bank set up by the Irish government back in 2009 to address the financial crisis in Irish banking. And so in that context, I have a particular interest in one of the standards that we'll be talking about, which is IFRS 9. I am also chairman of Ireland's Health and Social Care regulator, HICWA. And last, but by no means least, I am president of ACCA for 2017, which has been a very intensive role. I have responsibility to steer ACCA on behalf of the membership and ensure that we are delivering value to our global membership base and having a positive impact on the development of the profession. As you all know, ACCA is the global body for professional accountants, and we operate on a large scale around the world. We have 198,000 members and 486,000 students. We play a critically important role in assisting understanding of IFRS around the world and in promoting IFRS as global standards. IFRS has been part of the ACCA qualification since 1996, and as you may know, we additionally offer a diploma and certificate in International Financial Reporting Standards. So today I'll be covering the major new standards that companies who use IFRS reporting will have to implement shortly. The first two, IFRS 9 and IFRS 15, will first apply to accounts for 2018, while IFRS 16 will apply in 2019 and IFRS 17 in 2021. I will also take a brief look at some of the other developments from the IASB. While the first 3 of these new standards were developed jointly with the US Financial Accounting Standards Board, or FASB, meaning there are parallel, although not identical, changes in US GAAP. However, these represent the end of the convergence program between IFRS and GAAP, and we will see more separate developments in the US and elsewhere. I will briefly touch on this at the end of the webinar. So first, IFRS 9, financial instruments, and this standard will be replacing IAS 39 from 2018. All companies will be affected by this standard, as financial instrument refers to any financial asset or liability, trade receivables, as well as loans, derivatives, and investments. However, banks and insurers will be more affected than most because of the extent and variety of such items. IFRS 9 introduces three major changes. One, in relation to classification and measurement, most financial assets, loans and advances to customers will be measured at historical cost for traditional banks, but traded items and all investments in equities will be measured at fair value, that is, market value. So most liabilities will be measured at cost. The biggest change from the existing standard IAS 39 is on the impairment of financial assets, which I'll discuss in more detail shortly. And finally, there are changes to hedge accounting to improve its flexibility and practicality. So, financial assets do not have to be stated at fair value, but can be at amortized cost when both of the conditions on this slide are met. Their cash flows consist solely of interest and capital repayments, and they are held for the collection of those cash flows rather than for sales, say. So, in effect, a conventional banking environment. Their amortization referred to would be of initial costs and of discounts over the life of the asset. Most loans to customers by banks and the trade receivables of other companies can be measured at cost. Fair value through other comprehensive income gives, in effect, an income statement based on historical cost, but the balance sheet at fair value. This category is needed for banks and insurers that have portfolios of investments in bonds held as liquidity reserves or to cover liabilities or insurance claims. Fair value through profit or loss will include all derivative contracts, investments in equities, and items held for trading. The income statement reflects all changes in fair value, upwards or downwards. The fair value through other comprehensive income for selected equities is an option. The difference with the other fair value through other comprehensive income is around the recycling of the gains or loss on disposal and the impairment treatment. This may be helpful for companies that hold strategic stakes in others that are not held for short-term gains, so the fair value through the profit and loss would not be so relevant. Impairment is only needed for historical cost items. If items are at fair value through the profit and loss, then the loss of value will be recognized automatically. The current incurred loss model needs objective evidence of loss before any provision for impairment can be made. And this led to significant criticism that IAS 39 recognized them too little and too late, particularly during the financial crisis. The expected loss model in IFRS 9 instead requires all incurred losses to be provided plus some element which looks forward and provides for expected losses to occur either in the next year or over the whole life of the asset. So in effect, IFRS 9 will increase the provisions the banks have to set aside for non-repayment. It is a more judgmental, subjective system. There is a major change to impairment of financial assets in IFRS 9. And you will see the three categories on this slide. The distinction between categories 1 and 2 is that for 2, there must have been significant credit deterioration since the origination of the loan. And if you take the example of a 25-year mortgage, all are in category 1 to begin with. There is provision for the losses that have been incurred, plus the losses on any of the loans which can be expected to default within 12 months. If for any there has been credit deterioration, then they become category 2, and the full lifetime expected losses must be provided for right away. So this is a critical distinction. The difference between 2 and 3 is the extent of interest recognized in the income statement. So companies may need to collect new data to comply with IFRS 9. For example, to support the distinction of credit deterioration, what constitutes default, original effective interest rate, and so on. This is the key difference between IFRS 9 and US GAAP versions of this standard. In the US, all loans must have their expected lifetime losses provided from the start, so there is no category 1. And in effect, in the US, using US GAAP, there is going to be a higher level of upfront provisioning than through IFRS. Hedge accounting remains under IFRS 9 as a voluntary option. The three sorts of hedge relationship remain: cash flow, fair value, and investment in a foreign business. The bureaucratic approach remains. Hedge relationships have to be designated at the beginning, and that must be documented. The effectiveness of the hedge has to be tested, and any ineffectiveness must be written off. In moving from IAS 39 to IFRS 9, there is some relaxation in these rules, including what can be hedged and changing effectiveness testing to a prospective test only. The intention is to make hedge accounting more flexible and practical. Currently, quite a lot of companies may hedge exposures but do not do hedge accounting because of its complexity. And perhaps as a consequence of IFRS 9, we will see more take-up of hedge accounting. In summary, around IFRS 9, and particularly in relation to impairment, one of the major changes between IFRS 9 and IAS 39 is the introduction of what is in effect a general provision. And that's really what is introduced through that new standard.
It's time for poll 2. Let me launch the poll for us. Okay, thank you all for participating in the poll. Brian?
Okay, so I'm back and I am moving on to IFRS 15, which is revenue recognition. And this is another standard that applies to all IFRS reporting companies, but the impact on reported numbers is harder to predict. It could change the timing of revenue, which is probably the single most important reported figure. IFRS 15 replaces existing accounting standards IAS 18 and IAS 11, and from 2018, IFRS 9. You can see on this slide that there is a 5-step approach to revenue recognition under IFRS 15. Identify the contract with a customer. Secondly, identify the separate performance obligations in the contract. Thirdly, determine the contract price. Fourthly, allocate the transaction price to the separate performance obligations. Finally, recognize revenue when a performance obligation is satisfied. These 5 steps seem reasonable and fairly similar to what companies might do at present. The first will perhaps have the least impact, as there must be a contract before revenue can be recognized. There may, however, be more than one contract, and they will be needed to be considered together where they are closely related. In the second step, companies need to identify the separate performance obligations in the contract. Distinct goods and services are classified thus if the customer can benefit from goods or services either on their own or with other resources that are readily available to the customer, and the promise to transfer the good or service is separately identifiable from other promises in the contract. That is, not using the goods or service as an input to produce the combined output. Good or service does not significantly modify or customize another good or service promised in the contract. And the good or service is not highly dependent on or interrelated with other goods or services promised in the contract. Goods and services that are currently in one contract may need to be divided into 2 or more performance obligations. Separate performance obligations could be, for example, mobile phone contracts where there may be a handset and airtime, or another one, for instance, a machine sold with maintenance and or service support. Warranties, for instance, on goods are a more complex example, and if these are standard legal obligations, you would not have to separate, but would have to reserve the cost. If they can be purchased separately, then it is a separate obligation. The third step is to determine the contract price. There is variable consideration to think about here. For example, volume discounts that you offer, bonus payments you may be due in a construction contract for meeting progress targets, or interest charges for delayed payments. However, this must be calculated only to the extent that it is highly probable that significant reversal will not occur. So, in other words, quite prudent. Variable consideration will be estimated using the expected value the sum of probability weighted amounts in a range of possible consideration amounts. So, that's quite complex, or the most likely amount. And this method should be applied consistently. There must also be consideration of any significant financing component. The promised amount of consideration should be adjusted for the time value of money if the timing of payments provide the customer or entity with a significant benefit of financing. This can exist regardless of whether the promise of financing is explicitly stated in the contract or just implied by payment terms. And there is no need to adjust for a significant financing component if it is less than 1 year. The next step is to allocate the transaction price to the separate performance obligations. This should be based on standalone selling prices if there are observable prices for the goods or services when sold separately. The standalone selling prices could be yours or indeed those of competitors. Variable consideration may need to be allocated proportionately. And finally, the performance obligation is satisfied and revenue is recognized. So the criterion is the transfer of control of an asset to the customer. And control refers to the ability to direct the use of and obtain substantially all the remaining benefits of the asset. If there is alternative use for the output, for example, specialized work from one particular customer, control passes as the work is done. If there is an alternative use, control probably has not passed until all obligations are crystallized. If companies are currently using the IAS 11 percentage of completion method, they may well be able to continue to recognize revenue over the life of the contract. However, they can't assume that to be the case. They must look how IFRS 15 tests of the transfer of control apply to their contracts. The satisfaction of performance obligations is not necessarily based on location or legal control of the asset. Under repurchase arrangements, for example, control almost certainly has not passed, although legal control has passed. At this step, you also need to determine if performance obligations are satisfied over time, or satisfied at a point in time. You can generally assume satisfied over time unless if not. Examples of difficult cases here include property development, consultancy reports, software. It's difficult to identify the point at which the control passes. So, poll 3.
Okay, we are ready for poll 3. Well, we have a lot of fellows here. Okay, I'm closing the poll. Thank you. Brian, you can continue.
Excellent. You can hear me again?
Yes.
Yes, good. Next on to IFRS 16, leases. And as with the previous standards I've been discussing, the leases standard will also affect nearly every reporting company. IFRS 16 will replace the existing standard IAS 17 from 2019 onwards. And unlike with IFRS 15, the impact of this standard is going to be clear. Any business leasing property, vehicles, or equipment will be impacted. That impact will be more assets, more liabilities, and changes in profit. The extent can be estimated from existing accounts. Under IFRS 16, all leases will be accounted for by the lessee by recognizing the right to use an identified specific asset for the lease term. The cost of that asset will be at the outset equal to the liability to pay the rentals over the lease. The asset will be written down over its useful life like any other. There will also be an interest cost for the payments spread out over the lease term. This is currently the treatment applied to finance leases or capital leases under US GAAP, or indeed to outright purchases financed by a loan. It seems easiest to illustrate the effect of the standard with a simple example. So, as you can see on the slide, Business A leases a machine for 4 years, which is half of the expected useful life. Rental payments are £3,200 a year. Business A's incremental borrowing rate is 10%. And the net present value of payments is £10,144. And there are no optional extension periods or purchase options in the lease. So how would this be accounted for in the balance sheet at the start of the lease, and what would the P&L and EBITDA effects be under the current standard IAS 17 compared to the new IFRS 16? So here's the treatment under IAS 17. The balance sheet is nil, with a disclosure of commitment of £12,800. The P&L is £3,200 a year over the 4 years, and the EBITDA deduction is £3,200 a year over the 4 years. And here is the treatment under IFRS 16. On the balance sheet, an asset and liability of £10,144 is recognised. The balance sheet asset is the right to use the asset over the lease term, not the whole asset. At the start of the lease, this is calculated as equal to the liability, that is the net present value of the minimum payments under the lease. The asset is then depreciated in the normal way, as you can see here on the slide. The liability is decreased by the lease payments made and increased by a notional interest charge. If EBITDA is used, what was a cost deduction becomes interest and depreciation, so there would be no deduction at all. So here is a table comparing the P&L effect under IAS 17 and IFRS 16. Over the life of the lease, the cost is clearly the same under existing or the new treatment. However, there is some front-end loading of the costs under IFRS 16. This is the key difference between the IFRS and the US GAAP versions of the standard. In the US version, the interest and depreciation can be combined to produce a straight line effect rather than the front end loaded effect which we see in the IFRS. There are some areas of IFRS 16 where judgment must be applied. For example, operating leases under the existing standards are treated in the same way as any other service contract. Distinguishing them now makes more difference. For example, do you lease a photocopier and have the maintenance supplied? Or do you have an agreement for the supply of photocopying services? Other difficult cases are the payments to access telecom networks. And some leases have optional extensions. There may be significant incentives for these to be taken up, and the preparer must assess to determine the economic substance of the lease term. Payments under the lease are discounted to their present value, and this always raises the issue of what discount rate should be used. Under IFRS 16, this should be either that implicit in the lease or the lessee's incremental borrowing rate. IFRS 16 potentially means that a major data gathering exercise will be required for all leases. However, there are significant options as practical expedients to reduce this, like excluding any leases which are for less than 1 year, or small leases where the value is less than $5,000. So that covers the major standards that will be affecting balance sheets in the next couple of years. But there are a few other IFRS developments and updates happening as well, which I'm going to allude to. IFRS 17, which was issued earlier this year, deals with insurance contracts, and it applies from 2021. It will have a major impact on the insurance company accounting and reports. This is clearly a narrow but very important sector. The insurance has been a long time. It's been around 20 years in its development as a standard. And despite that, it's still going to be quite controversial. Currently, insurers are accounting using national systems, and they are now moving to a global standard. So all insurers will have to change the way they report, and the restatements will need explaining. And I suspect that they will need all the time to 2021 to prepare, change their systems, and to get used to the new reporting provisions. The contract will be stated at the net present value of the future cash flows, that's premiums coming in and claims to be paid out, plus a risk margin and a contractual service margin, which in effect represents the expected profit margin. The effect in the income statement will mean no longer recognizing premiums with provisions for a variety of items like claims, unexpired risk, and so on. Under IFRS 17, there will be a release of the risk and contractual service margin over the life of the contract, with any changes in cash flow expectations. The financing effect will be reported separately from the underwriting result, which should make understanding their accounts simpler than at present. And there is no equivalent change in standard for the US. Here on this slide you can see a selection of other developments. IFRS include a conceptual framework which sets out a number of fundamentals that underpin the standards. One such fundamental is the characteristics of good financial reporting that the standards should achieve. For example, relevance of the information to the users, its truthfulness, understandability, and so on. It also includes definitions of assets and liabilities, income and expenses, etc. The framework helps explain the standards and helps the IASB develop new standards in a coherent and consistent way. A revised version is expected to be published soon. The IFRS conceptual framework is comparable but not identical to the FASB frameworks. The IASB are considering how to improve reporting by ensuring there is more relevant information disclosed and less irrelevant information, including redefining what is material. It may also look at what IFRS information can be included elsewhere in the corporate reporting package. This work stream is referred to as the Disclosure Initiative. The primary financial statements project will look to improve the presentation of performance in the income statement with relevant subtotals dealing with non-GAAP measures and perhaps better alignment with the cash flow statement. There are about 20 other projects that the IASB is currently examining. FASB are also looking at these areas that I have pulled out, but it is not yet clear how coordinated the outcomes will be between the two bodies. And so to conclude, the implementation of the first three standards that I cover today will have an impact on nearly every company using IFRS. IFRS 9 will certainly lead to restatements of balance sheets for banks. IFRS 15 may lead to significant restatements of revenue, speeding up recognition or slowing it down. It is harder to predict, but it will be interesting to see what comes out of this over the next year or so. IFRS 16 is further off, but the likely impact is great, especially in terms of the size of balance sheets. Finally, IFRS 17 will have a huge impact on the accounts of insurers. Companies are only just starting to assess the impacts of this standard. Discussions of IFRS 17 and its impact will increase immeasurably as we move towards 2021. And so that is today's webinar on IFRS and the updates. Thank you very much.
Thank you very much, Brian. And thank you all for participating in today's webinar. As soon as the remaining webinar is scheduled, we will notify you. Please remember that your CPA certificates will be emailed to you within 3 business days. And an evaluation will pop up on your screen once this training has ended. Thank you and have a great day.